Hey, how's it going, everyone? Welcome back to another brand new video, and I'm presenting you guys today a video on how you're able to almost double your risk reward and your profits on winning trades without having to increase your risk. And this is something that a lot of people do not know about, but it's called scaling in. And today I'm going to dive deep into the specifics of how I personally scale into some of my trades that are A plus setups, and how you guys can do the same to maximize your upside while keeping legit the exact same risk of only -1 R on your downside. And I know that sounds like crazy and great, and a lot of people don't understand how that's possible, but I'm going to show you guys today how that is actually mathematically possible. So there's actually two ways of scaling in, and for those that don't know what scaling in means, it just means adding to your already running position or trade. So for example, let's say you were in a trade here. Let's say you were going long here. I know the chart is red here, but let's say you're going long here, right? Scaling in is essentially adding to your trade. So let's say you're going long here and you want to add to your trade on this pullback. This is called scaling in. You have your initial entry here and you're adding more to that initial entry or trade idea later at a good price. That's the point of scaling into trades. And what this does is it almost 1.5 to 2 times your upside, your winning trades. Now, it's not going to be always the exact same. It just depends on entirely how much you're scaling in with, as well as where you're scaling in, right? If you're scaling in very close to your TP, it's not going to increase your upside by much. But if you're scaling in almost basically near your initial entry, that's going to be basically 2 times the upside of your winning trade. What does that mean? If your initial trade, it was a 3R target and you scaled in near your entry, like let's say price came back to your entry again and you scaled in and added more to your position again, you take your 3R trade initially, add another 3R on top, considering you're risking the same percent on the scale in, you initially have you basically have a 6 risk reward upside. Now, majority of times, it's very unlikely that you will get the exact same or very close to that initial risk. You likely will get an entry scaling in somewhere close, but not quite exact, right? That good of a price. So typically, you could probably get 3 risk reward and you get a 2 risk reward, which is basically a bit more than 1.5 times your upside, which is very, very good. That's really good in trading, right? The point of this is to improve your equity curve. So rather than having equity curve that looks something maybe like this, something like that, it increases your winners. So your winners are much bigger, and therefore you can have an even better equity curve than you had before. Now, for me personally, scaling in is something that I've always thought about, but I haven't really done or executed too much myself personally until I would say the past few months. And the reason why is my equity curve was already really good because at a 65% win rate at a 3 to 4 risk reward average, that's my trading strategy that I teach all the course members, you guys, right? It's already a really good expected value of a trading system. I don't need anything better, but I noticed why not try to make it better if there's ways to make it better. However, I want to try to make it better without having to reduce my trade frequency, because trade frequency is an important part of compounding your personal account. And I also don't want to add more risk to my trades or my trading portfolio. I don't want to be increasing my risk as the account size gets larger. And typically, you start decreasing your risk as your account size gets larger. But anyway, the point I'm trying to make is that I was trying to find ways to basically grow my results in terms of my statistics of my risk reward even better without risking more. And that is where scaling in came into play. Doing some research on scaling in methods, and that's what I came to as my conclusion and solution. So that's what I'll be sharing with you guys in today's very important video, how to scale into trades. Now, how to scale into trades. If you are trading, let's say you take your initial entry here, what is your max loss here? Let's say you risk 1% per trade. Your max loss is -1 R here. If you were to scale in again, people would ask me, well, isn't this doubling my my downside? I'm actually losing 2 risk reward if I scale in and also hit stop loss, right? I'll lose 2 risk reward here. How are you keeping the same risk loss, really? How are you keeping and maintaining a -1 R loss still, keeping the same loss, but almost doubling your winners. How is that even possible if you're trading like this? Well, here is the key. Listen carefully, guys. If you take your initial entry, going long here, obviously in this case, you're going long. You know what? I need to change this color. It's kind of bugging me. There you go. If you're going long here, no, it's worse. If you go long here, what you do is you move your stop to break even at a certain point in your trading, right? Most people have a break even trade management system. You need to backtest to see where you break even and how it affects your equity curve and your win rate and risk reward. Or not your risk reward. Your risk reward is typically not affected unless you're scaling in, which is different. But typically your risk reward is not affected. It's mainly going to be your win rate that's going to be affected if you implement a break even system, whether that's good or bad. That's up to you to decide where you break even. But let's say you break even. What you do to get rid of this risk is go break even on your first position. That's it. That's all you got to do. Once you go break even on that first position, you are risk free. And what I mean by that, you don't have any risk on your first entry. Okay, which is cool and all, right? Your first entry has no risk. But then how about the second entry when you scale in? Well, when you scale in, you indeed will have risk. Your risk is -1 RR. So what is the total loss, worst case scenario of this trade if it hits stop loss? If price eventually hits stop loss before hitting your TP, what's the worst case scenario? Worst case scenario is you only lose -1 RR because your first position, lot size, contract size, whatever you did on your first position will get hit out at break even, and then the scaled in will get hit out at stop loss. So -1 RR. And you can assume this is -1 RR and not -0.5 or minus less. If you obviously on your scale in, if you're obviously risking like a different percent of your account on the scale in than your initial trade, then yes, of course your loss can be bigger or smaller, right? If you're doubling down on your risk on your second trade, double the size of your risk of your first initial trade, yes, you will have a -2 RR trade because break even plus -2 RR. The key here is never do that. Never ever double your risk on a scale in. In my opinion, when you're scaling trade, keep the exact same risk that you used on your first initial entry. So if you initially entered on your first trade idea of 1%, for your scaled in, enter with the size, contract or lot size that will match 1% risk. That way you end with -1 RR with still a good upside potential there, right? You get the benefit of the upside while reducing risk. Never ever double down like that. Now, there's another method. So this is method 1. That's method 1 of scaling in. Let me make a title here. How to scale into trades properly. And I'm going to make this bigger. And in fact, take a screenshot if you want to. How to scale in properly. That's the title. There we go. Let's go over method number 2. And me personally, I'm not going to go over much about method number 2 because I don't like this method. It overcomplicates the math and statistics behind backtesting this, and I'd rather keep the math as simple as possible personally, just to not overcomplicate trading too much. Trading is already somewhat complicated. It gets easier, but it's still a complex. The market is complex by nature anyway. So you don't want to make something that's already complicated too even more complicated per se, if it's already complex, you know? The second method, guys, is where you essentially here, you take partials on your first trade. So the second trade where you scaled in, you're still risking the same amount. So you would still have a -1 RR worst case scenario on your second trade. But you take partials on your first trade. So let's say you take partials here. Right? Say this is a losing trade. You take partials here. And if you don't know what partials is, just look it up real quick. You'll understand real fast what it means. It's basically taking partial profits, closing part of your position in profit. When you take partial, what happens is you also reduce the amount of contracts and lot size you have at risk. Therefore, if you take a partial and remove half of your risk is cut in half, right? If you remove half your profits, your risk is cut in half. So your risk on your first trade will then become negative 0.5 IR, and then the second trade will be a full -1 IR. Now you're scaled in, you can also risk half a risk reward if you want to, if you know you're in a partial, so then it still adds up to -1 IR if you like. But typically you would have a full same risk on the scale in, right? To try to maximize that upside. Otherwise, I don't really see much of a purpose in doing half risk here, because at this point it just adds up to -1 R, where you're just trading one trade. Like it just doesn't make sense, right? It doesn't make any sense. So you're scaling with 1 R. Therefore, now someone asks, why would you ever do a system like this where you're taking on more risk while having roughly the same upside, when you can just take less risk and have the same upside? Well, here's the catch here. In a trade like this, let's say something like this occurs and it hits your TP. What happens to this trade method 1? Well, your position gets hit out at break even. So here's break even level. For your first trade, your first entry gets hit out at break even. Therefore, the potential profit, let's say the potential profit for your first trade was, I know this is not drawn to scale, guys. Let's say it's 3 risk reward. Potential profit, if you didn't get hit out break even. And obviously second trade will also be, we'll leave you at 3 risk reward. It's likely not going to be 3 risk reward. It's going to be less because your stop loss is bigger. But let's say it's 3 risk reward. All right, fine. We'll make it more accurate, guys. We'll make it 2 risk reward. Right? Well, what happens here? What's your total downside? -1 R. What's your upside? Your upside is 2 risk reward. Why is that? Well, because your price action hits out your first position at break even. So therefore, when the scale in isn't as useful anymore here. This is the worst case scenario, when it hits you at break even level and it goes to your TP, because then your scale in isn't really useful here anymore, because it's the same as just taking basically this trade here, right, by itself. You don't have the leverage that you did with 2 positions equaled out, right? You only have 1 position left here. But if you were to trade method number 2, if price goes to your break even area and then continues in your direction like this, and when I mean break even here, I mean the same exact trade that hits this area here, right, where you would have break even. But for method number 2, because you have not entire risk of 1 risk reward on your first trade, you could technically risk this like this and not go break even for method number 2. And if you don't go break even for method number 2, what happens is you maintain the power of the upside. So remember, the upside is 3 risk reward and 2 risk reward. So method number 2, you actually, the upside will be actually 5 risk reward compared to only 2 risk reward, because you still have both positions open. Now, granted, this is actually not plus 3 point risk reward here, because it's plus 1.5 IR. Since you guys know you already took partials, right? You already partialed here to reduce your risk here. So I probably should have done that, clarified that more. Your upside is indeed 3.5 risk reward, which is, again, still very good compared to this upside. You almost doubled your upside here. Not doing moon or break even on your first position, but rather partialing to reduce your risk. So method number 2, you're partialing to reduce your risk to leave your original stop loss in case something like this occurs where it goes back to your TP. While in method number 1, what you're doing is not partialing, you're holding to full upside, which means you have greater upside potential. If price never goes near your break even for your first entry, goes something like this, then you'll get an upside of 5 risk reward, which is better than this upside. Now, again, like I said, this just complicates things too much to me, okay? I showed you guys a simplistic way here, but there's so much factors when it comes to trading, also psychology, that it just complicates everything, guys. You want to make trading as easy as possible for psychology as well, not just reading the chart and technicals. And I just don't like method number 2. It complicates things too much, but I just wanted to show you guys in case you guys were interested in partialing, or if you do partial in your trades and want to try method number 2. If feel free to go backtest. Let me know what your data shows from the difference between method number 1 and 2 and how it affects your P&L, win rate, things like that, net risk reward. But I'm just showing again today the benefits of both sides, right? There's pros and cons to each different type of method. I personally just will teach you guys today method number 1 just because it's easier to understand, right? So you guys can see essentially how this works. So if price does go back to break even, method number 1 has a worse upside. If price never goes back to break even, method number 1 has a higher, better upside because you get benefits of both positions at full contracts open, while this is partial, half position, and full position, so not as much money, right? Now that you guys, I'm not gonna put an X in check. It's not necessarily a wrong or right. It's just more so, like I mentioned, more complicated. And I'm gonna just draw this out real quick, and I will take a screenshot, and you guys can take a screenshot if you like to save this for those that are interested in scaling in. I will mention while I am doing this, one thing you want to be careful for scaling in is I would not recommend you guys learn how to scale in and do this until you consistently can be profitable without scaling in. Because if you're not profitable without scaling in, I doubt you would be profitable with scaling in. Because when you scale in, yes, it will improve your upside, but it also causes psychology issues, and you have to be really careful with managing your risk because of having 2 positions open or even 2 positions in futures, which in case it will be averaged, right? So you really want to be extremely careful if you're gonna do this scaling method. So I would recommend only if you're an advanced trader or you think you're experienced enough to do this scaling method. Otherwise, if you're a beginner, definitely stay away from doing scale-ins until you're comfortable managing a typical trade, right? So I would say this is, in my opinion, not my preferred way. I prefer this way due to simplicity. Okay. Let's see if I can. I'm gonna remove this upside downside. It'll just annoy or people won't completely understand. But you guys get the point here, right? There's 2 different ways of scaling properly, and I'm gonna take a screenshot real quick. You guys feel free to take a screenshot as well if you want. All right, there you go. Boom, took a screenshot. Now we're gonna go on the charts and show you guys how to do method number 1. I'm not gonna go over method number 2. It's literally the same thing. You're just taking partial, adding their position. Let's go over method number 1 now, guys. So here's the charts here. Let's just make a trade up, okay? I have some trades highlighted from before, but it grouped up, and it's gonna clutter my chart too much. So try to keep it clean, right? I probably should start deleting some stuff. I don't want it to get too laggy. But let's find ways to help you guys understand scaling in. So preferably when you're scaling in with the method 1, right? We're only talking about method 1 for the rest of this video and the course. If we're talking about method 1, you preferably want to scale in your trade, not where you think price will not go back to your break even of your first position. Otherwise, the scale in is basically pointless because it's the same as having just 1 position, since your first position will be moved to break even. So what I mean is you only scale in if your stop loss or where you're placing a trade is likely not going to go back to break even. So you don't want to be scaling into your trade too early. Let's say you enter this position here. You don't want to be scaling in your trade here. Preferably you don't want to. You can. Feel free to backtest. This is not something that's very mechanical. Scaling in can be somewhat discretionary, honestly, depending on your setup, right? If you scale in here, there's potential price could still come back to hit you break even on your first position. You don't want to do that. Remember, your first position, typically you won't be moving to break even. You can, of course, at your break even method strategy, but if you're trying to do scale ins, you typically won't move to break even until you have an area where you confirm you want to scale into your second position. So let's say price did this, broke that internal break structure, came back here, and you scale in here. This is a perfect area to scale in at after that internal break structure in your direction. Boom. Because what happens is now is you're anticipating this low to hold and price to not come back here, and you scale in here perfectly, right? But if you, again, like I mentioned, if you scaled in too early, price could still here, before taking out the high, it could still come back to do some wicking or mitigation again and then take out that high, which then what happens here, you get taken out of your initial position and you just have one position left, and you don't take advantage of that scale in power. When you're scaling in, you really want to find wares when you scale in that you are able to, there's no 100% probabilities in trading, right? But with high, what's the right word? I don't know exact word for this, but basically with high conviction, that's the right word. With high conviction, you want to make sure that you're able to ensure with a high percent that you can, that price won't go back to your break even on your first position. Otherwise, it's useless. Like I said, right? You want to be able to make sure that price can maintain the break even of your first entry and then the minus typical normal stop loss for your second entry. Because your second entry will have a normal stop loss, right? Your stop loss will be placed where you normally place it at, not at the break even area. It could be at the break even area if you really want to, right? For example, but I don't want to overcomplicate. I don't like overcomplicating trading this much. This is a ton of math to digest if you're really going to back test. This is too much. I think this is over optimization to a certain point, right? So what I mean by this is taking a trade like this, where you maximize your risk rate even further because your stop loss is bigger on your second trade. You can even triple your profits this way. And your stop loss for your second scale in is at the break even area of your first trade. So you still lose -1 R here, but if price wants to do something like this, you get stopped out early and it goes back to your TP. So it overcomplicates too much. But if you understand what I'm saying there logically, you understand. Otherwise, if you don't understand what I said logically there, just ignore that because it's not necessary, not needed. So let me see if I can find an example of where you could potentially scale in. I would say a good way to scale in is when we create that internal break structure, right? Or we create a lot of displacement. If we create a lot of displacement, you want to find like a, either you want to wait for a stop hunter setup, or you want to wait for a retracement back to like a OB to scale in. So let me see if I could find a good example for you guys here. Like, let's say you entered, this is not that good, but let's say you entered this IFVG here. Thing is, you would already hit TP here, so not really a scale in. So you can find other examples here. Okay, let's say you take this trade here. Where's the OB here? Perfect. This is very close to hitting your break even. Let's say you take this trade here. This is your first entry, entry number 1. And your TP is at the high, the weak high here that you deem weak because we're external pro trend. This is trade number 1. And you go break even here. Sorry, you don't end in break even, you go break even here on trade number 1. It barely hits. Almost hit. Where do you scale in? Let's say you have this position floating right now. You're looking for where you want to scale in, right? Well, let's say you take out this high. Right, we take out the high. Where would you scale in? Well, you could scale in after taking out the high. And if you're short and taking out lows, and with a lot of displacement or little displacement, that's up to you to define when you want to scale in. Let's say you wait for, you don't want to always enter on the breakout, by the way. It's just not the best pricing. You always want to wait for a pullback, even when scaling in, guys. Even when scaling in. Because likely price will make that pullback. Price doesn't move in a straight line. So let's say you have a limit order here set at this OB here, right? To expect mitigation here for your scale in. So this is trade number 2. Boom. So you have trade 1, trade number 2. Now let's see what happens here. You obviously, as soon as you enter trade number 2, trade number 1 goes to break even. Or you even break even at this internal break structure, and then you add trade number 2. Whatever you want to do. Point is, you must, basically the point is you must be at break even by the time you add your second trade. So whenever that is, that's up to you when you want to go break even. But as long as you're break even before you add that second scale in entry, that's fine. break even here, and you scale in here. So what's your upside here now? So your upside here is 2.5. So we'll just round it 2 and 1.3. We'll just say 1. So instead of making 2 risk reward, let's take this away. If you're just taking one trade here, no scaling, you'll make 2 risk reward. Now, if you add the skill in, you're still risking -1 RR here, right? Your worst case scenario is -1 RR for both situations. With one trade, if you don't break even, it's -1 RR. If you stop loss, with 2 trades, it's still -1 RR if you stop loss because one position is break even. So the downside is the same here, but the upside is now 2 + 1. So you have a 50% increase in your upside now, right? 1.5 times, right? 2 times 1.5 is 3. So boom, you just basically gave yourself an extra risk reward in terms of positive risk reward. And what this does is, in case it gives you a buffer, let's say the next trade you lose, that's fine. Why? Because you had the extra buffer, right? It gives you a psychological state of mind. But again, psychologically, it's not easy to manage skill in trades. You have to make these decisions when to break even, things like this. That's why try to keep it as systematic as possible. Break even anytime before essentially you skill into your second trade. That's what's most important for this skill in to really work without having yourself open to too much risk. So that's one example here. Let's see if I can find another example. Honestly, I'm gonna make this smaller. This is huge. Let's see if we can find another scaling example. Good trade here. Let's see. Boom. Inverse fair value gap model here. You guys should be able to see it with your eyes. I should not need to mark it for you guys here. This is also very close here. Wow. Let's say you're targeting this PY here. Okay. Originally, it's a 2.83 risk reward. So we'll round this to 3 for today. 3 risk reward here. Where do you scale in? Okay, let's say you're in this trade here. And let's say we have, where is it? You have our break structure here internally. Now, after this internal break structure, you can even make your own rules, right? When you want to scale in. Maybe your rule is, another rule you could do is, once price reaches 50% towards your TP, find a retracement to scale in. So when price hits 50%, you then look for a potential unmitigated OB to scale into. So let's say this is OB right here, right? There's so many ways you can do this, but let's say this is another option you can do. 50% to TP. There is an OB right here. They scale into. You set a limit order there, you scale in, and you keep the same TP. So now you have a 3 risk reward trade with a 1.5. We'll do 1.5. Okay. Now, a lot of people might ask, for my scaling, could I actually put my stop loss covering the OB for my scaling? You could. And this would significantly improve your scaling and buying power or upside. Because now this is 4 risk reward here, guys, almost 5. So you're literally going from 3 risk reward to 7 risk reward net. So almost literally more than double, right? But typically, unless we sweep some sort of internal liquidity like these highs here, because we can still, price either mitigates or it sweeps, right? If it sweeps highs like this, it could go down lower because this is a stop under setup, right? So you would then get stopped out too early, right? So you want to be careful. The safest bet, like I mentioned, the most conservative way is to just have your stop loss at the original trade idea and move your original trade always to break even before your second trade. Scale in. But if you really want to try to find ways to maximize risk for that much, go ahead and let me know your back testing results. So here, let's just keep it the original way, guys. So 3.5 or 4.5 risk reward versus 3. So 3 is without scale in, 4.5 our upside is with scale in. So if we do the math, that is another 1.5 times your upside. 1.5 times upside, right? This is great. 1.5 times your upside. Let's do one more example. I don't want to make these videos too long. So, boom, perfect example here. We have an OB entry model here, guys. Right? Okay. Now, let's say you... Okay. We already made this change character. Let's say you want to scale in at... Let's see what this is. Is there anything? Sometimes you might not even also get a scaling opportunity, so don't always think you will get one. It's not guaranteed, right? If prices shoots up with momentum after mitigating your initial entry and goes towards TP, you don't have anywhere to scale in. And again, don't chase scale ins like these time of breakouts. It's just not worth it, in my opinion, right? You want to make the scale ins worth it. It's an internal break structure. Again, you could do that or wait until price reaches 50% towards your TP, wherever your TP is. That actually aligns with internal break structure here, basically. And after that occurs, you move obviously this to break even, first trade to break even. And then you find a potential PY retracement. I don't see any here, I'm not gonna lie. This is not, like, see this? You could, like, here, look, you could not even wait for this internal break structure here and just scale in here again, but this is just risky, right, guys? This is just very close to your initial trades break even, and I think it's just more risky. In this case, it worked out, but that's higher risk, more aggressive. And I like to be aggressive in my trading, but maybe not that aggressive, right? Because I still want to maintain my good high win rate. And in this case, let's say we swept this low here. Okay. Let's say you took out that low here and you could scale in with a stop runner strategy here. Boom. And let's say your TP was that high right there. So you have 2 risk reward. Let's call this 3. And this is 2. So instead of just making, if you were just trading your initial strategy, you would make an initial 3 risk reward. But if you scaled in here, you would have made 5 risk reward. So in this case, you actually made a little bit over 50% more on your trade because of scaling in. All right, let's do one more example because why not? I think we got some time here. Let's see if I find any examples where you do go break even on the trade. Let's see. All right, so this is an OB entry model here. So that's your first initial trade. Let's say your target is here. This is a reasonable target here, this PY right here. I'm just marking out real fast, guys. It's not exactly precise for now. So your initial trade is about a 3 or 4 risk reward. Initial trade. Now, where do you want to scale in? Let's say you did a spray structure. Never took out that high. It's not really a setup here to scale in yet. Let's say you wanted to scale in here. You have this massive OB here. You scale in here. Now, here's the thing here. You actually would have hit break even before you get the chance to scale in here. Because the rule is, general rule of thumb is you want to go break even on your first position before you're scaled in. Otherwise, let's say you don't go break even here before you're scaling in. You scaled in or something. Here. You have very little time to really go break even before price does something like this. If price does something like this, it will take you out on both trades -2 RR. That's not ideal whatsoever. So in this case, you actually wouldn't really have a chance to break scale in really and take advantage of price. You take this trade here off the OB entry model here. Let's say you were targeting here. See, this is one of the situations where price is continuously in one momentum and there's no scaling opportunity at all given. You won't be given a scaling opportunity every time. Like even here, very hard to scale in here. Price just dumps and doesn't come back to mitigate anything. Not easy to scale in. Let's say you took an image for a value gap model here. This is a massive stop loss, by the way. probably would just skip off. You just if your trade stop loss is too big, you just skip the trade if you're not feeling it, or you take it with the big stop loss or try to tighten it. But in this case, it's very difficult because these OBs are unmitigated here, so price could easily go down there. But let's say you had a farther target, for example. Let's make this interesting. Let's say you had a target up here for that wick right there, right? Let's say that was your target for your first trade, and you're already break even by this point. I hope, right? This is, I mean, price moved a lot in your favor, so hope you're break even by this point, and you scale in here. The stop hunter strategy, or you can scale in on the OB mitigation. Again, if you have a tight stop loss for your scaling, it's gonna be rough. But you also can't. You could scale in theoretically like this, like I mentioned, keep the same stop loss as your original trade, and it'll add 1 risk reward at least to your trade. So instead of making 3 risk reward here, your upside is 4 risk reward here, which is, what is that, 25% more. So not bad, right? You're still adding 1 risk reward, better than nothing, better than no scaling in. But the only problem is, like, obviously if your TP is too far, too bad, you get hit stop loss. Stepped out. Let's see. Oh, let's see. Right here, I did indeed put the stop loss at the stop hunter stop loss. So you guys can see, I personally, if I were to go in with a stop hunter setup, I prefer to have my stop loss here tighter than something far, because stop hunter, usually your stop loss would be too big if you were to place it at your original trade. But if you're trading like OB mitigation that's very close to original trade like this, I think it's fine per se at this. But again, all depends on personal preference, how aggressive you are with your skill in. Even if you do a non-aggressive approach like this, you're still gaining more benefit than cons, because your con is basically roughly the same really on your downside, but you're just increasing your upside really, right? But let's say you were taking a stop hunter here with the stop hunter setup here with the skill in, and you still, remember, you still have this position open, you don't close this position yet. This is 3 and 5, this is 8 risk rewards. So instead of making 3 risk reward here, you make 8 risk reward. This is almost triple, guys, triple your upside by scaling in. Triple, right? This is the power of scaling in. Now, again, if you're a TP here, let's say you TP'd at 1 risk reward here on this trade here, and then you took this as a separate individual trade, that'll be 6 R. It still is not as good as a skill in trade like this, right? 8 risk reward. And of course, remember, always break even first trade. Always, always, always. Never take a -2 R loss. It's just not worth it to me at all at that point. There's always more opportunities in the markets, and you don't want to have too much drawdown on your accounts either. Now, one last thing before I want to end this video. I know it's getting quite long, but for me personally, for me to scale into a trade, I'm really looking for A+ setups to scale into. I'm not going to scale into every single trade I am taking, guys. I'm not going to do that. In my personal opinion, the best option is to scale into trades that are A+ setups. And I will make a separate video. And I think actually I probably already have uploaded a separate video by now of, I'm making a video basically explaining confluences that will make a trade A+ setup between, basically make a higher probability of playing out in terms of win rate than a B setup, right? So we have our A+ setups and we have our B setups. So I'll go over confluences on that. But point is, I typically only do scale in for these setups, A+. For B setups, typically do not do scale ins. Okay, and you may ask, why is that? Well, it's because, let's say I don't want to break even on this position. Okay, let's say I do break even on this position, right? And let's say price does actually come back, because a lot of people ask, if there's no downside to this system, why would you not to scale in, and why would you not want to scale in on every single trade you take? Well, this is the main downside here I'm gonna talk about. It's not a huge downside, but it's still a downside. If you were to leave this at break even, taking no scale in versus break even, right? But if you were to scale in, you would take -1R if price goes against you. So if you after scaling as the price is something like this and hit your stop loss, it will hit your stop loss here and hit break even here. So you end up with a -1R instead of a break even if you only had one position open and you did move to break even. So that is like really the only time where it is the con or the downside really to this system, but it's much better than overcomplicating to the partial system, right? So if you guys do understand now, for me personally, I skill in mainly just the A+ setups now. If you want, feel free to skill into both setups if you like, or all your setups. But personally, I try to stick with the A+ setups I know have a very high probability where I can skill in and maximize my trades. And again, don't do this until you've mastered how to take these setups with just one trade, right? Anyway, that's it for this video. Hope you guys enjoyed, and let me know what you guys else want to see in the videos. Yeah, that's basically it for me. Check out the mentorship or the course if you have not already, and I'll see y'all in the next one. And join the free Discord server. Also, if you haven't, you should already have a course member role or whatever if you join the course to have access to the private course group chat in the server. So I'll see y'all there.